All right, folks, welcome to Investing for Beginners podcast. Today, Andrew and I are going to talk about light bulb moments we've had along our investment journey. We're going to talk about some good things and some maybe not so good things that we discovered along the way. And hopefully, you guys can take some information and knowledge and some experience and wisdom away from our light bulb moments. So, with that, I will turn it over to Sir Andrew and we can go ahead and get started. So, what was one, I guess, light bulb moment that kind of struck you?
This sounds so obvious, especially because we've had a lot of people on our show who have talked about this, but it took me a while until I figured this out. Basically, this idea that a company can grow out of a high valuation or growth at a higher rate can lead to a higher return. So just that idea from Charlie Munger that if a business is earning 6% and it's growing at 6% a year and it's quote unquote fairly valued, and you have a business that's earning 8% and it grows 8% year over year and it's fairly valued, putting all this in quotes, they're going to end up at the same place if at the end of whatever period of time they were also fairly valued. Obviously, Wall Street and the stock market's way more complex than that. But keeping that in mind, I think as a value investor, I didn't respect that enough. And then I remember plugging in, and this like changed my spreadsheets since then. Like it's been a life-changing thing for me. Is like I had the first piece, I had like the DCF piece, but then I didn't have the whole how does growth play into this. So when I remember putting out a spreadsheet and like literally having it grow, having the numbers grow from one cell to the next, the next, the next, and then playing that out. So like one stock that stayed fairly valued grew at, let's say 12%. And then one stock that was 60% cheap, so it had a 60% bump and then only grew at like 2% or whatever. And seeing the higher growth win out in that case completely changed how I thought of things. So it's not just margin of safety and you can buy a cheap stock and you can earn, 20-30% on it, but over a longer time period, a higher growth will probably take care of that. Now, it always depends on what numbers you're talking about, but that was a big light bulb moment for me.
Yeah, that's a great one. That's a great lesson to learn, and I know it has changed how you look at companies and how you analyze them. So that was a great lesson for sure.
Yeah.
I think I've had a lot of light bulb moments. I think one I'll start with a negative one first, and that was making an investment in Intel uh, a few years ago. And I think the light bulb moment for me was in hindsight discovering, you always it wasn't a good investment. It didn't end up well. It didn't turn out well, and you always want to try to take away from failed investments. Why did this happen? And I think it was a combination of things. Number one, I don't feel like I knew the business well enough. I didn't understand what it is they were doing and why they were starting to do poorly, and I didn't get it. So I couldn't put the connection together. I just saw that the stock price was dropping and that other people that were far more knowledgeable about the company than I were saying fairly negative things about the company. And because I didn't really understand that they had lost their edge, if you will, and were starting to fall behind, I missed the signs. And I also overestimated the impact. So I remember telling Andrew this. One of the things that I liked about them was that they were spending more in R&D than AMD was making in revenue, who was their air quote big competitor at the time. And so my assumption was that the fact that they're spending more on just R&D than their competitor makes in revenue puts them leaps and bounds ahead. And how could they possibly fail? And that was wrong thinking. I discovered the whole Innovator's Dilemma book after this all happened, and that kind of helped me understand really what AMD was doing and in large part what Nvidia was doing. In hindsight, it's easy to see now, but at the time it wasn't, at least for me. And so the thing I took away from this is that I have to I have to better understand the business model, and I have to better understand the intricacies of the business model and the interactions between competitors and what competitors are really trying to do. Sometimes they're not directly competing in a particular segment or part of their business, but it may be something tangential. And because management isn't paying attention, they can get caught flat-footed, and that's exactly what happened to Intel. And so that was a big light bulb moment for me. Was I have to be more diligent about learning how the business operates and competition and who could be coming for them.
That's a great one. So, since we're on the topic of mistakes, I'll share one that I haven't shared yet on the podcast, and it is a little bit more. I don't know if ethereal is the right word, but just kind of theoretical. So, don't take this super literally, but a light bulb moment of when a stock mm, does this transformation from having a bunch of growth investors to having value investors come buy the stock, that shakeout period can take a while. And so do not just jump at the first 20-30% drop and think that you're I made the mistake with Crown Castle of putting too big of a position in a time period where the business wasn't necessarily gonna rebound right away. And I think I did the same thing with Starbucks as well. So both of those companies have had these tough transformational periods. And so when I got really excited, because before their transformational periods and before I had bought them, they had really great 10-year track records. And then things started to become uncertain, leading to a transitional period. And when the things got uncertain, the stock crashed, and then I got excited. And something that I'm seeing now more kind of as a pattern is these stocks that have great growth periods and then they crash. And then instead of it being a crash and then stock price continue to go back up as the price kind of normalizes, I'm seeing like flat periods in the stock price. And for every instance where you see that, you can talk about like a Google dip where it's like everybody wishes they bought the dip in Google, or like an ASML dip. Like if you miss that dip, you're disappointed. But I guess there's different types of dips and different types of stock crashes. And so the stock crashes that come because there's transition in a business, you'll have to be a lot more patient on how long until that money gets made back. You might have a very hard time period of holding that stock versus, and I know this is like, it sounds easier in hindsight and it would be harder to do in the trenches, but just contrasting that from a stock drop where the business doesn't really have anything big that's changing. Those are more urgent value opportunities than a value opportunity where it used to be a great business, but now things are changing and now it's cheap, but now there's change that they're in the middle of happening. So that's a light bulb moment for me that there's two different types of buying the dip, I guess would be a good way to describe it.
That's a great example of circumstances like that. I had a similar circumstance happen with me with GameStop. I remember when I invested in the company, it was one of those value investor dreams, right? Everybody was talking about, what a great yield you're getting on your dividend and how cheap the company is and whatnot. And I think the light bulb moment for me was the fact that I realized I was ignoring what was really going on with the business. I was blinded by the numbers and the fact that everybody else was talking about how great an opportunity this was, but I was blinded by the fact that the business had actually turned and the company wasn't turning with it, and they didn't really have anywhere to go. And this is all pre-meme stock, so keep that in mind. There was a GameStop that was not a meme for a while, and I remember thinking that I was pinning all my hopes on a air quote turnaround. And as Warren Buffett has said many times, turnarounds don't often turn. And in this circumstance, he was right. And so there's a lot of wisdom we can get from Buffett for sure. And so sometimes his little pithy comments there's a lot of knowledge in there. And for me, that was a big light bulb moment too. When you're looking at a company, again, it goes back to what I said earlier about understanding the business and what it is they do, and also understanding the competition and what's going on in their whole industry and sector. I got lucky and bought Microsoft as they were at the bottom and starting to turn, because had changed management, and the turnaround was starting to happen. So I got lucky with that one. But with GameStop, I did not. And so I lost 75, 85% of my investment, something like that. And, when I eventually sold it, I was like, okay, lesson learned. Turnarounds don't often turn. And if I walk into a company and I'm expecting it to turn around, I probably need to either have a smaller bet or probably need to really strongly rethink how likely is this turnaround to turn.
Yeah, that's a good one. I'm gonna kind of steer it differently for now. This one's company specific. I think if you haven't looked at this company, it's an interesting stock. I'm not saying it's a buy now because it's gotten kind of expensive, but it's been a great stock for us. Usually, when you buy a commodity producer, that is a very cyclical thing. Commodities have a lot of supply demand. And so you'll have huge boom periods and then bust periods. And when you buy a commodity, it really, in the short term, you really have to get that cycle timing really, really locked down. My light bulb moment was discovering that there is an industry where it is a commodity, but it's not cyclical. If you take the price of that commodity and you look at it over a very long time period, it's actually up and to the right. So I'm talking about the aggregates industry. Martin Marietta, that's the stock we own. There's also a Vulcan Materials in there, and then there's a couple smaller players. But the reason why, I mean, there's several reasons why the price does that. Basically, the number of queries is fixed. So everybody talks about Bitcoin has a fixed supply, and that's why it's going to keep going higher. Well, similarly, so do quarries and crushed stone. And the crushed stone goes into concrete and asphalt. And so the fact that there are limited quarries, that you also need these government permits to mine a quarry, all of those things create this price in the commodity that is long term up and to the right. Whereas if you look at some other commodities like copper or something, you'll see swings up and down, up and down. And you can't really depend on necessarily getting that nice organic growth like you can in the aggregates industry. So that was a huge one for me. Light bulb moment that happened when I was just randomly listening to a podcast, and the guest was talking about aggregates and talking about that fixed supply idea. And then when that light bulb hit, I was like, I need to investigate this. And then I was like, I need to buy some of this. And I'm glad I made that a decent size. And it's been an interesting long-term investment for us.
Yeah, it's done very, very well. It was a great pick, and it's certainly not sexy, but it is done very, very well. I can't remember the last time, other than you, I've heard somebody talk about Martin Marietta. You don't hear it. It's not discussed. If you go on social media or you go in the media world, nobody's talking about that company, but it's been a great investment for us, along the way. And, I'm glad you discovered that idea, because that's a great light bulb moment for sure. All right. So I will throw out another one. This one was a little further into the journey than I'm probably a little embarrassed to admit, but was discovering how the financial statements connected. So once I discovered that light bulb moment, I was kind of stunned. Like I had learned, this is one of the challenges, if you will, of being a self educated investor, is you're going to have gaps in your knowledge, because there are going to be things that you may not discover right away, and sometimes you have to learn the hard way. And so discovering that the financial statements connected, so that for example, that the inventory on the balance sheet is connected directly to the inventory on the cash flow statement. And so the money that they're spending on the cash flow statement connects to the inventory that you see on the balance sheet. Those kinds of things were huge light bulb moments for me. Like, oh, hey, I can, because I got so used to looking at them in separation. Here's the income statement, here's the balance sheet, and here's the cash flow statement. And so understanding now that these items, these line items connect, and you can see where the money goes, air quote, through the business and through the financial statements was a huge unlock. So as you're reading the 10K and you discover that Amazon is spending so much money on inventory because they anticipate a huge Christmas rush, and then you see that on the cash flow statement, and then conversely, you see it on the income statement, you go, okay. So it's not just the metrics, it's also the numbers and how the money is moving through the financial statements. And kind of tangentially to that was I have always associated in my head the income statement followed by the balance sheet followed by the cash flow statement. But a better configuration is the income statement to the cash flow statement to the balance sheet. And because of the way the money moves, the income statement is really a P&L. It's an accounting number. The cash flow statement is the actual money, like the money that, Google is spending on different things going in and out of their checking account. That's the actual cash. And then the balance sheet reflects where the money is gone. And so it's once I understood how those all connected, I was like, oh, I can now start to kind of figure out the story that the company is trying to tell me and what the numbers are telling me because of the interconnection of the statements. And it started to make the Sherlock Holmes part of analyzing a company started to make a little more sense. And that was a huge unlock for me. And it was literally because I was reading a blog post and somebody said something about, this item going to this item, going to this item. And I was like, what? And so I remember I pulled up the actual, statements from that company. And sure enough, yeah, they were right. It went from here to went from here to went to there. I'm like, wow, that's awesome. All right. So yeah, that was a huge unlock for me.
Nice. I'll throw one out there that's kind of financial statement related that popped in my head while you were talking. So I've had some success buying stocks that were like the leaders in their industry and also had the best gross or operating margins in their industry. So I'm talking about like Dick's Sporting Goods and McKesson. And so I had some early success with those. So I assumed that you can just take that idea and that mental model and just blindly apply it in any industry. So I ended up applying that to CDW. And in hindsight, I think that was more of a mistake. And so to your point about when you said with Intel needing to know what's going on outside of the company and really in kind of like industries, either your own industry or industries around you, I think for CDW, and I haven't checked, maybe the stock price has gone through the roof because I sold it, as can happen, but not respecting, I guess, their place in their ecosystem and how there is a lot more competition going direct to them, even though if you were to line up on a spreadsheet, this company versus this company versus this company, oh, okay, they're the leader. But there's a lot, it's just a very fragmented kind of service that they provide. And so the mental model that applied in a more mature industry or a more consolidated industry did not apply to this fragmented high tech industry. And so that was a mistake that I don't know. I think I just came up with it one day where I was like, oh, maybe I made a mistake with CDW and then, ended up selling it. So I think it's one of those things, right? Like as in investing, we want to find these surefire toolkits. And there's always exceptions to the rule where a toolkit may work well in this context, but not in a different one. So I still think it's a great mental model. I think it's probably going to win more times than not, but I would also caution just blindly applying it industry to industry to industry.
Yeah, exactly. Because there's always oddities or exceptions, and some companies just don't always fit into our preconceived ideas or our models of this is using a PE ratio to try to value every company kind of thing. While it could be helpful for certain industries and certain companies, it just doesn't work. You look at Berkshire Hathaway, it just doesn't work, and so yeah, I love that idea. That's a great mental model to learn from. Uh, I think a light bulb moment for me was this revolves around valuation, and when I first started investing, the financial advisor I was working with did talk to me a little bit about valuation and the price you pay matters, and he kind of gave me that idea, and then he pointed me towards Warren Buffett, and I kind of started going down that rabbit hole. But it wasn't until I discovered guys like Joel Greenblatt and Michael Mauboussin and others that I really started to understand that, hey, there's a method to how you try to value companies. And so then I kind of came across Professor Demoterin, who I've talked a lot about throughout the course of the show. And I remember watching one of his videos and I understood almost literally nothing. Like the first hour and a half of his lecture, I was like, I have no idea what this is. And so I just started, kind of grinding through it. I listened to the whole, I think it was 24, 26 episodes, hour and a half each one. And I listened to all of them. Sometimes when I was at work, bad employee, driving in my car, boring my daughter to death. Anyway, I worked through all of them. And it wasn't until I started trying to build my own DCF model that I started to have a light bulb moment like, oh, I get this. Like it wasn't until I started trying to basically reverse engineer what Professor Demoterin's models were trying to tell me. And once I started trying to figure that out, then I started understanding, oh, this is why this is important. Oh, this is why this is important. This is how this impacts this. And so it wasn't just a matter of just plugging in the numbers. It was understanding why I was plugging in that particular number and how this number impacted the value of the business. And that was a huge unlock for me. Once I started to figure that out, then I was like, holy crap, this is how you can value a company. And while it's not perfect, and there's certainly modifications you got to make along the way, it can lead you to the promised land, and it can help you avoid making huge mistakes in investments thinking that everything goes up to the right, because it doesn't. And that was a huge unlock for me, like just monumental.
Yeah, that is awesome. It's cool that you learned by doing also, which
Mm,
meant you weren't afraid to get your hands dirty, and
mm-mm,
that doesn't necessarily come naturally to, I think, beginners certainly.
mm.
Along that line, when I downloaded Michael Mobison's Base Rates book, that was like light bulb moment after light bulb moment after light bulb moment.
Right.
To me, it's like if you've ever played poker and you realize that the two cards you get in your hand have odds, and every hand you could get has different odds, and you have that light bulb moment that's like, oh well, this makes the game a lot easier because then I know which hands are good and which ones are not. It's very similar when you download the Base Rates book. So that one really gave me a good, I guess, expectation on what's a reasonable growth rate and what's a reasonable outcome, what's a reasonable result. Obviously, me being the numbers guy, I love just to know what's the distribution of outcomes. And to me, if you know that, and obviously with history, history doesn't repeat, but I think if you know the distribution of outcomes, then you're a lot easier able to spot when things are reasonable and when things are Kool-Aid levels. So it was a really cool thing, because other than that, you're just kind of like, oh well, this person said they like 10% growth, or this person said, I'd buy anything with 3% growth. So it's like you just don't know. But then when you see a distribution of outcomes and you see the data, and he did a good job of like adjusting for survivorship bias and things like that. So it's just, yeah, it's very eye opening. And in a way, it's kind of like oh, dang, if I want to become a billionaire here, you really have to get lucky. So it's kind of discouraging in that way, but it is also pretty realistic. So um, if you haven't, it's a free download. Just Google base rates book and check it out.
Yeah, it's well worth reading, and I try to reread it, at least once a year, just to refresh myself on it. How many light bulb moments have we had with Michael Bobuson, right? Through
Yeah.
the years.
Yeah. Very
Could
true.
probably do an episode just on that alone.
Yeah.
Uh, I couldn't encourage his reading his writing more. And the cool thing is it's all free.
Mhm.
michaelbobuson.com I think is the website, and it's all of his writings are all compiled there through the years because he's been doing this now for since the late 90s, I believe. And so there's a huge swath of information there that you can learn from. Yeah, one of the light bulb moments for me was starting to understand ROIC, and that came directly from him.
Mm.
He wrote a very long paper basically breaking down ROIC. And I had, of course, come across the metric and understood that it was, NOPAT over invested capital. And okay, fine. But once I had to start plugging the numbers in and understanding how this number interacts with this number and how the invested capital drives the NOPAT, then it was just like, oh, hey, this is why this is important. And this is why this is important to understand. And then the whole relationship between ROIC and WACC, or weighted average cost of capital, and understanding those relationships, that was a huge unlock for me, because then I started to, okay, this is important. It shows you not, the numbers in and of themselves show you how well the company reinvests, but the gap between the two shows you how well they invest and what kind of growth you could probably expect to see over a longer period of time. To kind of go back to what Charlie was saying about the 6% return, if a company is reinvesting at 6% and they're growing at 6%, you probably can't expect much more than a 6% return. But if a company is growing at 10%, but their ROIC is reinvesting at 20%, you could probably expect a better return going forward. So I think once you understand those sayings and how everything interconnects, it's like this huge unlock, like, oh, I get it now, this is why this is important. And again, it goes back to understanding the numbers and being able to read the numbers and put a story to them and how that connects to the business. If you just look at them in isolation, it doesn't really tell you much. I mean, it does, but if you put it into context with what the company is doing and what they're saying and what you're observing over a long period of time, then that's how you can kind of pick out, okay, this is a really good company versus others that like are not.
Yeah. That's a good one. Let's keep it going of like investors that we've read. I'm gonna at least keep it going one more because I can think of
Okay.
another one. The guy who did 100 Baggers, Chris Mayer.
Oh, Chris Mayer. Yeah.
Yeah, he broke down kind of the anatomy of a 100 bagger. 100 bagger being you buy a stock and it goes up 100x. But he said there's three basic components. I'm paraphrasing. It's high revenue growth, it's a valuation expansion, and it's a margin expansion. And so for me, light bulb moment being like, we all, and I just said how I like to buy the leader in an industry with the best margins. However, when you have low margins, it is much easier to double or triple your margins, which doubles or triples your earnings per share. And when you have high growth over a long time period, it just multiplies your return. So, like looking at like a Costco, for example, and that's a way to watch it in real time of like going from a 2% operating margin to a 4% operating margin is quote unquote, I'm gonna put in air quotes, easier than going from 40% to 80%. Actually, that one's actually probably not a stretch to say, but it's true. So you can't triple 40% operating margin because you can't go above 100, but you could triple an operating margin that's like 2 and it goes to 6. So we've lived in an era of low interest rates and revenue growth is keen. But if we have a sideways market, I think it'd be interesting to see if margin expansion becomes a bigger focus for investors. And, shout out to Chris Mayer for illuminating how operating margin expansion can create literal multiples on your return.
Yeah. Yeah. And such a great book. So
Mhm.
so many great nuggets in there. That was a fantastic book.
Mhm.
Great lesson. Let's see. If wanted to keep the nuggets rolling from reading, I would probably have to say that the information that I learned about insurance early on in my investment career from Buffett
Yeah.
was huge. There is no better resource to learn about the insurance business than reading Buffett's shareholder letters. If you are interested in investing in insurance industry in any way, shape, or form, you need to read those letters because he is a master at that industry, and that's really where he's made the most money has been through the insurance industry. And it's not just Geico, it's all the reinsurance companies that they've bought along the way and just the knowledge that he gained. And he gained a lot of it by sitting down with, at the time, somebody higher up at Geico. He went to Washington on a Saturday, Washington, D.C., on a Saturday, knocked on the door. A janitor came and opened the door for him. And he asked if there was anybody there that he could talk about Geico, the company, and learn about the company. And the janitor said, yeah, some gentleman was sitting in his office. And so Warren went up there and introduced himself. And the guy talked to him for what, 4 or 5 hours. And taught him everything he knew about the insurance industry. And Warren learned really well, and he teaches really well. And so, if you want to understand what things like float or combined ratio, or how important it is about pricing and risk, and all the things that are associated with insurance, that is where you need to go to study at the foot of the master. And if you can do that, you'll have a better understanding of how to invest in insurance. And it really unlocked a lot for me, especially early on, because I was looking for something that I would be interested in, and that caught my fancy. And reading his letters were like, oh. So
Mhm.
yeah, it was awesome.
Yeah, I don't know if I can think of a better place for a stock picker
Mhm.
to have capital to allocate than an insurance company. So not rocket science, being that the best stock picker in the world has been doing it with the help of insurance float. So it is permanent capital. It is a great source of investment funds.
Yeah, for sure.
If you want to be a founder, forget AI startups. Go start an insurance company, build it brick by brick, and one day you could be like Buffett. Maybe
Yeah,
not as many
exactly.
bees,
Maybe.
but hey,
Right.
it'd be a good living. It'd be pretty safe.
Yeah,
It'd
for
be
sure.
fun. Yeah. And I guess this one's kind of partially like a company we own, and also something I learned from somebody who wrote about it. So, Nick and Zach from Nomad, they had such a cool run in the stock market. Didn't last super long, but they bought Amazon and they bought Costco. And it's funny is that they had the same competitive advantage mental model moat, which is scale economies shared. So we've talked about Costco ad nauseum on the show, but the idea of as you scale, you're helping your customers. So you're becoming more valuable to your customers as you scale. That's amazing. We think of capitalism, we think of businesses, we think of the fast food companies that I can't stand who are making my burgers smaller and my fries portions smaller as they get more profitable. There's very rare breed of companies that flip it as they get bigger. They share the benefits with their customers. American Express being another one. Um, and so the light bulb moment for me was that it appears that Microsoft's doing that with their cloud compute business, and I thought that's really cool. I don't admittedly know that part of the business as well as I know Costco since I shop at Costco, but it just appears to me that there could be that dynamic happening, and if that truly is the case, then cloud computing is a very, very strong business.
Yeah. Yeah, that's a fantastic example. Yeah, that their shareholder letters are again, that compilation is kind of a must read.
Mhm.
Because there's so much knowledge in there about the patients, about what you just talked about, and just how they look for businesses and the patients. They were very patient
Right. Yeah.
for sure. Well, with that, we will go ahead and wrap up our conversation for today. I hope you enjoyed our light bulb moments, and I'm sure you've had a few along the way. If you do, share them with us. Send them to us at newsletter@einvestingforbeginners.com. We'd be happy to read them on the air if you're okay with that. You could also reach out to us on the Spotify app, or you could reach out to us on the socials. And again, if you have any light bulb moments you want to share with us, I think it would be awesome to share them with the audience, because that's how we all grow and learn, is by all of our experiences. And so with that, we'll go ahead and sign us off. You guys go out there and invest with a margin of safety. Emphasis on the safety. Have a great week, and we'll talk to you all next week.